Welcome to XYPN Radio, where your host Alan Moore brings you into a community of fee-only financial planners who want to profitably and successfully serve Gen X and Gen Y clients. If you're ready to get the knowledge you need from leaders in your field, learn from forward-thinking advisors, and take action on your own goals, XYPN Radio is the show for you. Here's your host.
Hello and welcome to this episode of XYPN Radio. I'm your host, Alan Moore, and today I'm excited to have Patrick Brewer on the show today. Patrick is the founder of SurePath Wealth Management, a fee-only financial planning firm based in Austin, Texas. SurePath Wealth Management also has a niche subsidiary, SurePath Physician Services, which focused on, you guessed it, physicians. After career stints at Vanguard and DFA, Patrick ended up growing his firm after launching with $0 in revenue to over $250,000 in annual revenue in just 13 months. In addition to running his practice, he provides consulting services to financial advisors through his consulting firm, Brewer Consulting. Patrick and I talked about a lot of different topics, ranging from his time at Vanguard and DFA, his attempt to buy another RIA, which ultimately didn't work out and then led to him launching his own firm, and his path to $250,000 in revenue in just 13 months. Patrick is building a different type of firm than most advisors we have on the show, preferring to focus on building the business instead of being the lead advisor. So it's really interesting to hear what he's up to early on in the process. You can find any of the additional resources that we mentioned during the episode at xyplanningnetwork.com/130. Also, be sure to go to xyplanningnetwork.com/VIP to join our private group just for XYPN Radio listeners. It's the community of advisors we've all been looking for that's there to provide support when we need it the most. Best of all, it's free. I encourage you to check it out. Again, that's xyplanningnetwork.com/VIP. Without further ado, here is my interview with Patrick. Hey, Patrick, welcome to the show, man. Thanks so much for being on.
Alan, thanks for having me, buddy. Happy to.
I'm excited to have you on. Just in the conversations that we've had via email and before we started recording, there's going to be a lot of topics to cover today. So hopefully we can squeeze it all in. And if not, I always have you back on the show to dig in more. So give listeners just a quick overview of where you are at today professionally, sort of the business or businesses that you have, how many clients, where you're located, that sort of thing. And then we'll go back and sort of talk about the career path that led to the business.
Sure, man. So I'm located in Austin, Texas. My primary businesses are SurePath Wealth Management, which is an RIA. Got a couple of people that work with me in that. We've been operating for about 18 months now, a little bit less than 18 months. And it's been a fun ride, as you're aware, having coached a lot of advisors through the XY Planning Network process, I'm sure. And then just out of necessity, I feel like we launched a company called Brewer Consulting, which focuses on helping fiduciary advisors serve more people, mainly through marketing and sales strategies. So that's kind of where my focus has been. And then the RIA has grown pretty well over that 18-month time frame. I think we're at about 15 million in assets under management, about 7 in assets under advisement through 401ks. And we've just been really trying to aggressively grow that. And then, as I mentioned, a lot of the stuff that we've been doing to grow our practice has been in the digital space. So we spun up a separate company to help serve advisors and teach them how to leverage online marketing to actually work for them instead of them just tossing money into the fire and burning it. It's been a pretty busy 18 months for us.
So you said we and us. So who else is at your firm at this point?
Yeah. So I have an operations associate. His name's Ryan. He does a lot of the onboarding, client paperwork, technology and integration, and then focuses on basically helping advisors get up to speed with our marketing offer. So he has 2 responsibilities. One on the RIA. One's part of his responsibilities on the RIA, and second is the marketing firm. And then we have my partner, Tim Power, who focuses on the sales side. So meets with most of the clients on the front end with the RIA and is primarily responsible for getting them to the point where they're qualified and ready to have a discussion with myself to see if we can kind of bring them on. And then we're in the process of, we've got a lot of irons in the fire. So we're bringing on a CPA. I don't know how deep we want to go on this, but we're bringing on a CPA to start doing tax preparation and planning locally in Austin. So we're going to launch an entirely separate marketing and kind of sales division for that. And then I'm actually replacing myself as the lead advisor in SurePath. We're going to be bringing on a CFP, who's much more qualified. He's 48. He's got a full head of gray hair, looking awesome. Exactly what the clients want to see. They don't really, necessarily want to resonate with a 32-year-old guy who's trying to take over the world. So I'm going to be removing myself from the actual advice side of the business and focusing mostly on marketing and strategy And then we'll probably be bringing on a couple other people next year as we kind of scale up in both firms.
No, that's awesome. The one question I'll ask, and then we can dig into some of those other pieces as well. But with the CPA, so are you going to put them on salary and you just include this as a service offering, or are you bringing them under sort of they're going to run a subsidiary and they're a partner? Sort of how are you structuring rolling out, tax preparation as part of your service model?
Yeah, it's a good question. I went back and forth on it for a while to try and figure out the best way to do it. Initially, I was thinking, well, if I just hire somebody younger who can be on a salary, that might be the best bet. But I really needed somebody to drive that part of the business because, as you know, it's different than what we do. And there's a lot of different tech and a lot of different process that needs to be evaluated. So we're going to be working on the back end to empower that CPA to basically just do tax preparation and front facing advice with the client. The way we're structuring it from a compensation perspective is they're going to get a percentage of the revenue on the tax preparation business. And at some point, they may share in the wealth management and insurance revenue that we generate with the relationships that we have mutually between our tax focused business and our planning focused business. Initially, we're just going to have them be part of our RIA as SurePath Wealth Management. We're just going to market as one entity. We're going to gauge the success of that business line. And if it's working really well, we're going to roll out probably SurePath CPA Group in 2019 for tax season 2019. But for this year, we're figuring it would make more sense just to keep it simple and market as SurePath Wealth Management and just have her handle the service delivery aspects of the planning and prep.
All right. Fantastic. Well, we'll talk more about that. So give me sort of the rundown of your career, because you have, you said you're 32. Your resume sounds a little bit like mine, where it doesn't look like you can hold down a job. So tell me about sort of your path to where you are today.
Sure, man. Well, I graduated in 2008. And as you know, it's not a fantastic time to be searching for a job with the markets kind of melting down around me, the finance degree. So I took a job at Vanguard, and I ended up in the institutional services group, where I was basically helping plan participants with their 401k. So I would get like 100 phone calls a day with plan participants basically telling me that they wanted to go to cash. So that was my introduction to the financial advice or the industry. And after I took about 100 of those calls, I just sat there thinking, I just remember driving home after the first day, and I'm like, man, this can't be my life. This is just way too intense. I can't be talking to 100 people a day and just selling them out of their investments and going to cash. But a lot of these people had no framework because they had never been given any real advice. They were just operating based on what the world told them they needed to do, which was to be scared, to be uncertain. So I started to look for a different way. I started to do a lot of research, and I applied for initially a rotational program at Vanguard where I was going to rotate through internal audit, corporate finance, fund accounting. And I didn't get accepted the first year because there was like 1,000 applicants for one position. But I decided I was going to get it the second year. So I got my CPA while I was on the phones at Vanguard, and I applied for the rotational program the second year and got it. Went through a couple of the rotations and quickly realized that I did not want to be in the mid office. I just didn't enjoy audit or fund accounting or any of that stuff. I kind of delegate the details. So I started looking for a better way because I knew I wanted to be on the front end in the client-facing role, kind of influencing the outcome, so to speak. And my mom actually had moved to Austin, Texas, about 3 years prior to me kind of getting to this point where I was searching for another position. And she was working at Dimensional Fund Advisors. She was in the technology group, so she didn't have a great sense of what they did from an investment or process standpoint. But she met a bunch of guys in the financial advisor group and had told me like, hey, I think you would be a good fit for this. You might want to apply and just interview. So initially I was hesitant. I'm like, oh man, I don't want to work with my mom. That's just weird. But I decided to take the interview, and I loved everybody that I met with. It was just awesome guys, great investment philosophy, great approach. It was pretty much exactly what I was looking for because I knew I wanted to be front facing. So I took the job at Dimensional and started at the ground level. I was an associate, worked my way up to a regional director, and throughout my time at DFA, I was there for about 4 years. I consulted with hundreds of advisors, some in the broker-dealer channel, some in the independent space, and ranging across sizes. I had clients that were 10 million in assets all the way up to a couple billion. One of my relationships while I was there was supporting Loring Ward. So I got to see a good kind of subset swath of the industry while I was at DFA. And after about 4 years, getting my CFA and kind of working my way up as high as I could go, at least at the time in the organization, I started to get a little bit antsy. You know how that goes, Alan. you just decide that, hey, this wasn't really what I thought it was going to be. I can kind of get my work done in a few hours a day. And I just felt like I needed something more. So I ended up looking for the next thing. And what I settled on was trying to build a massive roll-up of DFA affiliate advisors, and then basically hiring in my colleagues at Dimensional who would make good advisors and creating this huge RIA. So that's what I thought I was going to do at age 27, like a prideful, naive 27-year-old would do.
All about having more confidence than skills at times. So.
Lots of confidence, not a lot of humility. So I ended up going into it, and we acquired a pretty large advisory firm. It was about $200 million in assets up in Sacramento, California. And let's just say it was a really good learning experience.
So you said we acquired. Did you have a partner to help fund the acquisition, or?
I did. It was actually one of my clients that I had worked with at Dimensional. They were kind of new to the advice space, but they saw an opportunity to basically affect that vision, which is to acquire a bunch of advisory firms and kind of pull them into a shared infrastructure model and, bring people in. So it was one of my clients that I was working with at DFA. So they put up the capital for the acquisition. And my contribution was basically to move out to Sacramento and do all the boots on the ground, sweat equity work, and kind of start to manage the relationships and, carry out that vision that we mutually had at the start of the relationship. So without getting into too much detail there, let's just say I learned a really good lesson. The one thing I learned without a shadow of a doubt is I only have one speed, and that is 100% on at all times. And everything has to be efficient, because at the office in Sacramento, there was like 3 working typewriters, and the process was kind of, in my opinion, a little bit dated.
Typewriters.
and honestly, I could have just coasted and become pretty wealthy, just kind of managing the expectations and the relationships and just kind of what was already there. Because it was a really successful firm and a lot of really good people, but I just couldn't stop. Like, I needed to fix things, and that just caused a lot of issues with everyone at the firm. So definitely learned a really good lesson, ended up kind of selling my interest in that company after about a year.
Yeah. Can I ask about that? Because that's an interesting structure where, you're putting in sweat equity, someone else is putting up the capital. So how did you determine, or how did you get equity in the deal? Sort of what was
what was my contribution?
Yeah. Well, I get the contribution just because you were sweat equity. I mean, it's a huge part of it, but like, can you tell me, like, what was the negotiation process like for you to become an owner when you weren't putting up capital?
I think it was just the fact that I was really confident that I was going to be able to create more value for the shareholders. And I've always been pretty good at negotiating. So I think that went into it. And also the fact that I sourced the deal, and the owner had built an emotional connection with me and not with my partners. So I did have some leverage there. I think that's primarily the reason why they decided to go the equity route. And then also, I had a pretty good job at Dimensional too. So if I was going to leave and become part of a roll-up, attempt, let's call it, it would have to be a pretty good deal. Otherwise, leaving Dimensional is kind of, not many people do it.
Right. Well, yeah, you went from one cult to another. So, and I say that in just because I'm a big fan of both Vanguard and DFA, but they do have very strong cultures, both internally as well as just sort of their philosophy on investments and that sort of thing. So usually you're either in or you're out. There's not a lot of in between. Folks are like, I sort of like DFA.
Yeah, it polarizes, right? Which is why it sells, because people are either, as you said, they either tune in or they tune out, and the exclusivity of it lends itself to people committing either one way or the other.
So, okay, so you sold your interest in the RA. Were you able to sell back to to your funders, or did you find someone else to come in and be boots on the ground to get wealthy with typewriters? Or
could be a good business name, Wealthy with Typewriters. I like to trademark that. I actually ended up selling it back to my partners, and they were more interested in kind of growing that business and cultivating it. It wasn't a good fit for me, so I ended up selling it back to them, and then I moved back to Austin, Texas. And I didn't really know what I wanted to do at that point. I debated going back to Dimensional and just continuing to work for a company. But at that point, I felt pretty confident that I was unemployable, and I was probably right on that. So I ended up actually doing something completely unrelated to our industry. I was frankly a little bit jaded on financial advice, wealth management in our industry after that experience, because I felt like it just, without getting into the details, I just felt like I was kind of, taken advantage of. In hindsight, I was just naive, but I needed to do something different for a period of time. So I ended up creating a company called Simple Medicare, which is focused on providing seniors with the correct Medicare coverage, totally different than wealth management. And what I thought I was going to build was basically a quoting tool for people to be able to sort their options when they were entering the years in which they had to select a Medicare plan. And we set out with the best intentions. We did a lot of research, got some developers, and after about 6 months, we finally got an MVP up. But once we started to get deeper into the client profile, we realized it wasn't an issue around creating a tool that would allow people to adequately sort their options. It was more of a lead generation problem, because getting people to buy health insurance, whether it's under 65 or over 65, the hardest part is just getting in front of them, because it's one of the most competitive markets in the world. Everybody's running lead generation for healthcare because it's designed to be specific and it's transactional, which means that there's going to be a lot of competition. So I actually had to shift all of my focus to figuring out how to drive leads online in a way where I wasn't going to run out of money in 2 months. So that kind of led me to researching all of the different ways to get attention online. So I started focusing on Facebook ad strategies, LinkedIn, everything, in order to try and build any level of consistency around selling Medicare services. And after about a year of kind of tinkering with stuff, I finally was able to put together a process that allowed me to consistently get new sales through a call center environment. And then we also had some in-person workshops we would do as well. And while we were kind of building this business, I started to realize that I hated Medicare. It took about a year, but I didn't like the fact that a lot of the agents were unethical, that it's very sales driven. It just didn't feel right to me. It wasn't where I wanted to spend my time, but I really enjoyed the acquisition side of it, the marketing side of it. So I ended up switching the focus of the Medicare business from just selling Medicare to using it as an entree to get in front of people, solve a problem for them, build trust through execution, and then introduce the idea of working in a more comprehensive way to solve problems around retirement income, taxes, retirement, and all the traditional stuff that advisors do when clients get to be a little bit older in that life stage. And we saw some really good traction with that. So from there, I kind of just continued to introduce other types of marketing funnels and approaches to grow a wealth management firm. And that's kind of how SurePath was born 18 months ago, as we decided to just give it a shot, and it ended up working. And then we just started to grow from there.
Now, do you have your CFP, or are you a CFA? What are your designations at this point?
Yeah, I have a CFA and a CPA, so no CFP. I don't think I could bring myself to take another exam.
No kidding. So when did I'm assuming this CFA came while working at Dimensional, since it seems like everyone there has the CFA.
Yeah, I needed to put the time in if I was going to move up, but honestly, I did not enjoy the process. I don't know if anyone really enjoys the process of studying for the CFA. I kind of brute forced it. Burned out once at level 2. That was brutal, but managed to get through it.
And then CPA, when and why did you sit for the CPA? Just out of curiosity.
That was back when I was at Vanguard. The only way that I could figure out how to differentiate myself when I was taking phone calls and participant services was to get a designation, because otherwise we're all homogenous. There was no way for me to be different to get that accelerated rotational program. And I didn't like accounting particularly. I didn't really like that too much either, but that was the fastest way for me to differentiate myself. So I just figured I'll get it. And that's when I got it.
Okay, cool. I was just curious. I was just thinking through the background. So when you started SurePath, you really, correct me if I'm wrong, but you really hadn't done financial planning. You really had been on the how to build the business side, not necessarily the lead advisor working with clients side. Is that fair?
No experience with planning. I didn't really get introduced to any of the clients in Sacramento. That was part of the issue, but I had to figure out the financial planning side of it once we started our RIA.
So talk to me about the decision to start the RIA. Sounds like you have a unique skill set, which we don't have a lot of in financial planning, which is marketing, and actually beyond just getting into actual inbound marketing strategies and that sort of thing. So why start an RIA at that point? And how did you go through that process? Did you start it with a partner initially, or were you lead advisor sort of out of the gate?
I was the lead advisor. My colleague, Tim, who's not an equity owner in the firm, but does a lot of the sales and the relationship management now. I met him while I was still running the Medicare business, and we kind of jointly decided to start SurePath when we saw that people were more open to working with us after we solved a problem for them through Medicare planning. And then from there, we just reinvested all of our time and our energy in continuing to acquire, obviously, more clients and then refine our marketing strategies.
So it's interesting. So if you don't mind me asking, but did Tim not want equity, or you were putting up the capital and it just wasn't a conversation? I'm curious why he isn't an equity owner at this point.
He might be at some point. He didn't really express a strong interest at the beginning. Honestly, we both went into this with the mindset of, we're not sure if this is going to work. And I knew deep down that I didn't want to build the 100 client, $100 million practice. That's just not how I'm wired. But I saw an opportunity. What I think, honestly, the reason why I started the RIA is because I wanted to kind of prove it to myself that we could start an RIA from ground zero with absolutely no natural market, no connections, and really no help, and get it to a sustainable level. And he was on board with that mission. So I think at some point, Tim may be an equity owner, but we've got multiple businesses now and his focus is kind of split. So recently it's been just a process of figuring out what people want to do and what's their leverage purpose, right? What's going to allow them to have the most level of satisfaction in their work. And Tim is honestly the type of guy who just likes to interface with people, right? But he doesn't like to follow up. He doesn't like the relationship management side of it. He just likes the sales and the emotional connection side. So that role to me is less of an equity owner because there's less strategy, there's less decision making. It's more front end compensation to incent that behavior.
Gotcha. Yeah, it's interesting all the different ways that this gets structured. I was talking with some guys at Mariner Wealth, which is, I don't know what they're at now, 20, 30 billion. And no, maybe they're bigger than that. Anyway, based out of Kansas City, because I was there recently. But they have an entire business development team that exactly how you're set up, this is all they do. And they just get a percentage of revenue. I think it's 20 or 25% the first year and then 10% ongoing. And they don't do any financial planning. All they do is go get clients, which I don't hear of that a lot.
That's how it has to be structured. The challenge, what I've realized with our industry is most people today think that they can start a firm by themselves. But what I realized pretty quickly is I'm only good at a few things. And if I meet with clients, it drains my energy super fast. So I'm not going to grow nearly as fast if I have someone who's energized by meeting with clients and the front end of the sales process. I think that advisors should they should be teams. There's a lot of guys that are out on their own right now that are really talented, but only talented at maybe 20 to 30% of what it takes to build a $100 or $1 billion firm. The key is just finding those synergies and setting yourself up to where you're doing the right thing every day, or the thing you should be doing. It's going to allow you to grow faster. It's going to make the pie bigger. So I think there's a lot of advisors out there that just want to build that firm by themselves, but they're not. It's not because they're not good enough. It's a difficult business. It requires a lot of different skill sets in order to make it successful and to get scale.
Yeah, and I agree, assuming that the advisor is looking to build a multi-person business. I think there are a lot of folks that set out that say, hey, look, I want it to be me and an ops manager, me and an assistant, and that's all I want. Justin Rush comes to mind. He's a guy that he wants to build a book of business and that be it. But to your point, if you really want to scale, if your thing is I want to build $100 million, $1 billion business, there is power in specialization because you can't be great at marketing and sales and onboarding and client relationships and running the business. There's all 5 of those are different skill sets.
Yeah, but I would argue that if you're not good at marketing and sales, you'll never get to 100 million in assets, because the way that our business is designed today and has always been designed, and that's the reason why we have a lot of advisors that aren't great business owners, because you're incented for bringing in new clients. So the ones that actually get to that point are usually the ones that are good at marketing, they're good at sales, So it's difficult to create that $100 million business if your superpower, your unique your value proposition, what you're good at is financial planning, right? It's harder for you to do that because there is a marketing component to getting to that $100 million level.
It's interesting because I see both sides of this. And it's the interesting thing about financial planning. In most businesses, you are absolutely correct. In most industries, financial planning is this weird industry because we see firms grow despite having zero sales ability. And I'm not saying they grow as fast as they could, because if you bring in somebody that's great at sales, you see the potential. But I sometimes I fall back on it's just a supply and demand issue. Like we just don't have enough advisors out there. And so the fact that we have a massive shortage of advisors just allows folks to grow a business that wouldn't normally be able to. And some of it, and I think about the XYPN conference. I mean, this is a conference and our organization is a ton of startups. Like we should, on average, have an 80% failure rate in 4 to 5 years of businesses. And yet we don't. Like I don't meet any XYPN members that are shrinking. They're all growing. They may not be growing as fast as they want to, but they're still growing, which may lull some of us into complacency just because, again, we can grow it without focusing on some of these issues, but we can do better for sure.
Depends on, I guess, what you're trying to build. I mean, if you're looking to grow accidentally just because there's a higher level of demand than supply, I would argue that would be arbitraged away as people start to either enter the space or the people that can market and sell start to take your clients, because that means that there's value there that's on the table, and it's going to come to the person who creates the best business model to monetize that value. So I would say if that exists right now, which I don't necessarily know if it does, you would know better than me because you consult with hundreds of advisors that are at that stage in their business. But I just feel like there is a land grab for market share right now. There's an opportunity over the next 5 to 7 years to build a truly dynamic personal brand that will allow you to put the distance between you and everyone else if you do it the right way. I don't know if sitting on your hands, and I know that's not what you're advocating, is the best approach, right? Because I think that you will face stiff competition if you run your business like that.
I agree. I think the competition's coming. I don't think the competition is here yet. Here in Montana, the joke is you don't have to be faster than the bear. You only have to be faster than your hiking buddy. And I liken that to marketing and financial planning because you don't have to be the world's greatest marketer, because everyone else in our space is just so awful at it that just a little bit of effort, I mean, $3,000 for a website and blogging once a month actually puts you ahead of 90% or 95% of financial advisory firms that are out there.
I would just say that a lot of that, so with marketing, the challenge that a lot of advisors are going to face, and what I've seen in the industry, is blogging is one way to get attention. But the problem is blogging is only good if you have an audience. So what most advisors are terrible at doing is first building an audience. If you don't have an audience, you could blog 100 times a day, but you're not going to be able to have anybody interact or read your content. So I feel like our industry has done a terrible job of translating how people market in person to how they should market online. So if you think about a traditional sales funnel, what most advisors are, if they're doing this at all, I would say only 2 to 3% of advisors have even got this far. But what most marketers recommend that you do on the digital side is to set up a landing page or a website, offer a piece of collateral in exchange for an email address, right? And then you drip on people through email and you attempt to build a relationship. You attempt to get them on your list so they can read your blog post. But the problem with that is it's too linear, and you're trying to push people through a marketing funnel instead of building a relationship with them. So what we've done and what we're advocating for is this idea of building a relationship with someone in a nonlinear way actually requires more than just a linear marketing funnel. So I think that most advisors, if they're blogging, if they're using things like hearsay or just pushing out noise to their audience, what they're missing is the relational connection that can be established through video, through platforms like Facebook. There's an element of the relational side of our business that is missing to what most advisors are doing with their marketing online.
Said another way, it lacks engagement. You can either talk to people or you can engage in a conversation. And you are absolutely correct that a lot of times by just saying, blog or be on social media, what people end up doing with that information is they just share a bunch of stuff and never really actually build that relationship and engage with their audience.
Yeah, it's just noise. Our industry is notorious for just pushing noise out to people. I kind of view it like this. What I see most advisors do on their social profiles is like walking up to somebody at a coffee shop and handing them a page from the Wall Street Journal and being like, "Hey, are you ready to work with me yet? There's some good information on 529 plans there." They don't spend any time becoming relevant to their audience. All they do is just push out noise all day. And I think that's because that's what most of the consultants are telling them to do. It's not their fault. It's just they don't know a better way. So the first step is really becoming relevant to someone and then building that relationship in a non-linear way through your social profiles and building an audience so that when you create high value content, you're actually able to, as you said, engage them in a personal way so that when they come across a life event or something triggers in their life where they require advice, they see you as the most logical decision, right? Because you've already spent the time and the energy building a relationship with them.
Now, are you a niche guy and having an avatar and a really specific client focus, or are you more of a broad generalist in your coaching with advisors?
I love what you guys have done with the niche. I know you've been an advocate for it for a while, and I think that it absolutely works. So I didn't mention this. We have a separate DBA. It's called SurePath Physician Services. So the way that I've structured our practices and the way that I kind of consult with advisors as far as marketing goes is there's a couple different approaches. The first one is you can take an industry specific focus and market nationally, which is what most of the people in XY Planning Network or most of the advisors who have a niche do, right? So you would, in our case, focus on physicians, owners, of surgical centers, and you would structure your marketing and your approach to basically work with anyone around the country and deliver the services virtually through your computer, right? And that is a perfectly acceptable way to do it. But I think you miss one thing, and that is the human connection, which is what people are really searching for. I know there's a lot of articles and a lot of stuff that says that people just want more technology. They just want to meet through video conference because they're busy. And I agree with that to a degree, but people are getting overwhelmed with the amount of noise and stuff that they're subconsciously seeking that human connection aspect of what we do, which is ultimately what we've done all along, is connect with someone emotionally and help them throughout their life. So I think that approach works. We've been adding about 2 clients a month to that business just using online marketing, but we're also testing a different approach, an approach that has a more local focus. And it's the way I think about it is it's local and pain focused. So there's a lot of different pains that people come across in their life. Some of them are related to Medicare, to tax, to cash flow planning for business owners or budgeting for, young high earners. There's a lot of different problems that people could have. And, the thing with most people is they don't actually think about their life holistically. They don't sit back and try and generate a level of awareness about what their real issues are. They just kind of go about their life transactionally. So what we've done in SurePath Wealth Management, we're building an online kind of awareness sales funnel, a video sales funnel, leveraging multiple platforms to essentially dominate the market in 2018 for tax planning and preparation locally, because nobody really understands that process of building that relational connection. So I think you can do it either way. I think you can take the industry national approach, with SurePath Physician Services, it's for us all over the country, physicians, young docs, and we generally start with student loan consulting, and then we'll upsell holistic planning, tax planning, set up an S corporation, whatever it is. But you need to be able to build that trust through execution to be able to get them to want to do more higher level planning. And then on the local side, it's kind of the same thing. So I think you could do it either way, Alan.
Yeah, I think to your point, and this is we've talked about this a little bit on the show before, but the word sometimes, what am I trying to say here? When we say niche, people immediately hear professional niche, right? Doctor, lawyer, accountant. And that is not what we are saying, because there are a lot of different combinations of focuses that you can have. You can focus on specific pain points that a wide swath of people are experiencing the same pain point, and you can be the expert in solving that pain point. It can be a life stage. It can be, folks getting divorced, folks getting married, having children, selling a business, starting a business. It can be, like I said, it can certainly be professional. It can be faith-based. And Wasik on the show recently talking about integrating faith-based principles. He's going to meet with clients from a wide range, but they're looking for an advisor who understands their faith and is willing to integrate it into their financial plan instead of fighting them on it. There's so many, there's an infinite number of options when it comes down to it. It's just having, our whole thing is just you have to focus more. You have to focus down more than just we work with young professionals, because it just doesn't work. It doesn't resonate with anyone, and you can't build a relationship working with everybody.
Yeah, you're just noise then. Yeah, and then after that, right? Instead of just picking a niche and blogging, right? Because if you think about it, let's say I decided I was going to work with physicians and I stood up a blog and I just started writing, stuff about financial planning for physicians. How many people are actually searching for a financial planner doctor, right? Like the searches on those terms are pretty low. So you have to think about a creative way to build your audience if you're going to be focused on a niche, whether that's local and pain focused, whether that's a profession, whether that's a particular company. The first thing you need to be thinking about once you've made that decision, and that's a big decision in and of itself. One of the things that we spend an hour and a half with most advisors on, and we thought about a lot on our own, was, okay, what are we actually trying to build? Because I feel like a lot of advisors never really step back and have any level of intentionality around how they're structuring their practice and what life that's going to create for them. So, that's the first step, is really stepping back and figuring out the exact type of practice you're looking to build. And then after that, it's how do I build an audience? And if your answer is you just blog, or you run Facebook ads to your website, or you attend networking events, it's not going to work very well, because you don't have a sustainable mechanism for building an audience and delivering content that's going to actually get them to a point where they trust you, they trust the process, and they're ready to move forward. So I think where most advisors struggle is on the audience building side of it.
Where do you recommend advisors start whenever they say, hey, I have my focus, I have my avatar, if you will. So I know the pain point or the professional or whatever. I know the person I'm trying to serve. So where's your starting point on audience building?
It depends on where they live. So if you're going to be focused on physicians, then most of them are going to live on either LinkedIn or Facebook. The only real platforms that we found to produce any type of return on investment for marketing spend is Facebook, Google, and LinkedIn. But depending on the type of audience and the type of business you're building, you're going to either start on LinkedIn first, you might start on Facebook first, or you might be running targeted Google campaigns. A lot of it just depends on how your audience consumes information and the type of business you're trying to build. So generally, my recommendation is to start on LinkedIn and then to build the relationship through Facebook. So we have some ways where we essentially grab our audiences on LinkedIn. We can retarget them with video ads to basically build trust over time, so that when those people are ready, like I said, they just kind of see us as the natural best option. Because I feel like there's if you think about it at a high level, and you have 100 people in a room that are just regular people, right? Some of them high net worth, some of them not. 1% to 2% of the people in the room are going to be active seekers of wealth management services to some degree, right? And then 98% may be looking for a financial advisor at some point in time, or they may not. So with the 1% to 2%, we take a totally different approach than we do for the 98%. Because if you market to the audience as a whole, and you just say, here's an ad, click it, well, you're going to get a lot of unqualified traffic that's going to drive your cost up. So the key is to market to the 1% to 2% that are actively in market for the service one way, and then to build a relationship and relevance with the 98% in another way. That way, when they're ready and they're in market for the service, they're not coming in with a packet of papers from NAPFA and interviewing 47 advisors and saying, well, what's your fees? What do you charge? What services do you provide? I've been seeing your stuff, and you've become relevant to me. They're going to say, hey, I've just been seeing your stuff and I just wonder what it'd look like to move forward. I don't know exactly what you do, but it just seems like it'd be a good fit. So just shifting that conversation is what I feel advisors need to focus on online.
I think it's a great way of putting it, because I have said before, the way I built my RIA was just focusing on the 2%. It was focusing on being wherever people were looking for a financial advisor, because convincing the other 98 that they need help is a long road. That is a very long play. And I think sometimes advisors get caught in this cycle of like, oh, I'm going to go talk to people and convince them they need an advisor. And it's just not going to work in the short term. But you can be building a relationship with those folks while also focusing on bringing in folks that are looking for an advisor, because honestly, those are the folks that pay the bills and keep the business open long enough for you to actually be around when some of those other 98 folks are, seeking a financial advisor.
Yeah. And the key is figuring out a mechanism for getting in front of the 1% to 2% at a cheaper clip than your competitors. Because the problem is the 1% to 2%, everybody goes after them. And the people that are going after them are like Edward Jones, Merrill Lynch, Morgan Stanley, and they can monetize that audience a lot more effectively than we can. If you're doing fee only planning and you're starting there and you're trying to pay acquisition costs for the 1% to 2% that those players are willing to pay, you're going to have a bad time because they're going to outbid you for those people's attention. So the first part is figuring out how do you get the attention of the 1% to 2% in a way that's different from what your competitors are doing. And then, as you said, how do you build a content-driven campaign that's going to get the attention and the desire and build the relevancy with the 98% when they're ultimately ready to move forward? And then you just have to accept with the 98% that there's a level of silent ROI. A lot of advisors want to track things, but the sales process and the marketing process for those people that aren't ready to buy right now, it's nonlinear. They're going to see an ad, they're going to we're going to watch a video, they're going to get retargeted by, something else. And then eventually 6 years later, they're going to be ready to move forward, right? So you just have to be in the game long enough to build that relationship.
Yeah, I saw a study recently that Edward Jones, the vast majority of their marketing budget now is digital marketing because they are so locally focused. Because that's Edward Jones' thing, right? They put a guy or gal in a small town, and then they go knock on doors until they find people that just lost their job to roll over 401ks. But they're using local based search. In any town, if you look up financial advisor, Edward Jones is going to rank high. Now, that being said, the thing that they are missing out on, and they may change this focus, and this will no longer be the advantage, is that Edward Jones, Merrill Lynch, any of these bigger companies ultimately have zero focus. They work with anyone with money. And so I think that today is where advisors can, quote unquote, win in terms of attention because they can have focused content that actually engages instead of just getting eyeballs. So Edward Jones is just going to get eyeballs to say, oh, hey, here's a financial advisor. No one goes to Edward Jones and thinks, oh, yeah, this is the company for me. They really understand my problems. People just think, oh, they're another financial advisor. And so they're going to have to spend a lot more money on conversions than some of our advisors that do have a true focus because, again, they're able to engage with hyper-targeted content and therefore the advertising is a little more focused. So it's a win. Again, I don't know if that will forever be, I doubt nothing's forever. It won't forever be a way to, quote unquote, beat Edward Jones, but it is a leg up that advisors can take right now.
The way to beat Edward Jones is to be a dynamic personal brand. So the challenge that our competitors have is that they're just big. Right? They can't communicate like we can communicate. So what I've seen is when you shift, and every advisor wants to communicate like a business for some reason. But if you communicate from your business profile or anything as your business, you're going to get almost zero engagement. Why is that? The reason why you're going to get zero engagement is because people connect very, very uniquely with other human beings. So just that simple tweak in your mindset and the way that you market, if you market as a human, you will get higher levels of engagement. You will pay less for clients. You will be more relevant and you won't have to buy attention from other people. Another thing that I see is think about a guy like Dave Ramsey. There's a lot of advisors that have to pay to basically leverage Dave Ramsey's attention because he has spent time and energy, whether we agree with him or not, to becoming relevant to a very particular audience. So now you got all these advisors that have to pay him $1,000 a month for SmartVestor to essentially leverage that attention. So that I feel like more and more advisors, if they don't spend the time up front to build that audience, to cultivate those relationships, they're going to have to spend more and more money buying attention, either trading their time or their money for attention. And that's the only currency really that we have right now is attention. And it's at an all-time low because of all the noise.
So there are so many areas that you can do with marketing. We talk about this because we love, obviously Michael and I just love getting in and talking marketing and branding strategy and all of that. And when we make our list, our dream sheet of all the marketing things we could be doing in our world that's targeting financial advisors that are interested in starting their own firm, the list is endless. I can employ 100 marketers and still have more projects for them to do. So how do you help advisors and how do you personally prioritize which, projects will get funding and the focus because ultimately there's always going to be limited resources.
Well, I think it just comes down to what actually moves the needle. Like most people will invest in marketing, but they're just going to throw their money into the fire pit because they don't really understand what's going to get them the results that they want. So we've just created a very specific blueprint that starts with audience building. And then it goes into lead generation for the 1% to 2%, because a lot of advisors, the first thing that they need is at bats, right? If you're just starting your practice, you need help with sales training and you need at bats and you need to build an audience. So that's step one. For larger firms, you probably need to build an audience because most larger firms have just grown organically due to the fact that they were differentiated 10 years ago and they delivered great service. And that's awesome. That's going to continue to happen. But they've kind of run the course on their organic audience. So step one, building the audience. Step two, if you're a new firm, is to monetize the 1% to 2% in a way that's different from your competitors. And if you're a larger firm, it's about creating that relational connection, right? To foster the relationships and tell your unique story to your ideal prospect. So we have basically a process for doing that through LinkedIn, through Facebook, through direct email, through retargeting. But it's all kind of laid out in a sequence so that advisors don't do things out of order. What I saw is a lot of advisors want to invest in fancy marketing technology and analytics before they even have any traffic. Like there was one guy that I talked to who he spent a bunch of money on HubSpot and was tracking his analytics, and he had like 10 unique visitors a month to his website. So just essentially lighting money on fire, or investing in something like Infusionsoft, which is $200 a month to do fancy segmentation of your email list before we even have an email list. So the key is doing things in the right order at the right time and knowing which things are actually going to move the needle and which things are just a waste of time and energy.
And this is just my opinion, but with the state of where things are at in the financial planning industry, in my opinion, buying content from anyone at this point is a waste of money. So any of the systems that are out there that say, oh, we'll run your newsletter for you, or you can put our content on your website and get people's email addresses without naming names of companies, just ignore all of those, because ultimately, one, we're just not seeing any results from any of those companies. They're not showing an ROI. But again, you're getting too far ahead of yourself. I mean, we implemented HubSpot at XY in January, 2.5 years into the business, whenever we actually had, visitors to start segmenting and that sort of thing. And it's been a great spend. It was a good use of money, but it would not have been helpful in our first 6 months or 12 months, as you're saying.
For sure. You guys do a good job with the content marketing and getting your message out there. I mean, you generate a lot of buzz in the advisor community. So you're doing something right. The challenge for advisors, because what you're doing to get the attention of the advisor is much different than what advisors need to do to get the attention of their prospect. Because the B2B sale is different than the B2C sale. The B2B sale is more logical. And when a business owner makes a decision, what they're filtering in their mind is this service going to help me make more money? Can I serve more people? And is this the direction that I want to go with my business? Ultimately, that's what they're trying to reconcile when they decide to sign up for my service or your service. But the consumer, it's an emotionally driven sale. It requires a relationship to be built on the front end. And that's a nonlinear process. So when you start doing the same things that you do B2B on a consumer sale online, you're going to lose money because it's more difficult. It's more nuanced. So that's what we realized. And that's why I started our marketing company. Is I got burned so many times trying to figure out how to market to consumers that eventually I just had to peel back the onion and figure it out. And I'm learning new stuff every day. I don't want to sound like I'm the only guy who has this type of stuff figured out, but it is a different process getting the attention of someone for financial planning versus getting an advisor's attention for service.
It's interesting. I don't know if I fully agree with it, only because I can see where it would be on your consulting side because you're working with existing businesses, but well over half of our new members don't have a business. And so I think a lot of our marketing has been around, it's not around selling XYPN services. Our marketing is around what does it take to actually start a business? Like, what does it mean to start a business? What are the good and the bad? And walking them through the value proposition of the end result of what we promote.
It's results focused though, right? It's focused on you will create a business and you will get this result, right?
And I wonder if advisors need to be doing more of that. I see very little value proposition sales. Like very little sales is around the tangible values of financial planning. We market a lot around creating a great life and living your dreams and being financially independent and secure. And it's hard. Like it is emotionally driven, and it connects with people like, oh, I want to be financially independent. But I don't think we do the best job of as advisors of saying, here's the value of financial planning. Basically, you pay $1,000, you get $2,000 back. And we can't actually say that in our marketing, but we don't focus a lot, I don't think, or focus enough on the true value and the pain points in showing how we solve those pain points.
The challenge is most people don't care because they never have to make a decision to do proper planning. So what I've found, the value of advice, I think, the way I've explained it is it's highly related to the value of the other person's time, because if I'm not doing it, they have to do it. So that's step one. The other value is the opportunity cost of a mistake. So, what happens if they don't do these things? Let's paint that picture. And then the third, and it's a distant third in my opinion, is the value of the service. Because as you know, there's a lot of different technology and other things that can make that service more accessible. Now, some people will place a high value on the service and some people won't, but the real value is in the opportunity cost of the mistake and the value of the other person's time. And if they don't understand that, if the prospect doesn't understand the concept of leverage and they're just seeking out a service provider, then the challenge that the advisor is going to face is that service is going to become more and more commoditized, as you already know. So I think that the advisor needs to do a better job of painting the real picture, which is you have the propensity to essentially make bad decisions at some point in time, or you will have to counsel your spouse emotionally about money. Now, how that plays itself out from a marketing perspective, it's very nuanced and it's difficult, which is why most marketers have to lean into the services in order to get people's attention. And our carrots aren't nearly as good as other industries, right? So by saying you need to do proper financial planning, they're going to be like, cool, bro, I'll do that tomorrow. So I hear what you're saying and I agree with you. And I wish it was more focused on the unique value proposition and the fact that an advisor is an expert. I mean, one of the things that got me to this point is I came out when I started the RIA and I thought, oh, I have a CFA, a CPA. I'm a bright guy. These clients will see how smart I am. They're going to, once I show them my financial planning process and solve their problem, they're going to see how smart I am. And it was the exact opposite. I would be in the sales meeting and I would go through Right Capital and I would solve all their problems with minimal energy. And then they would look at me and go, cool, you solved my problem. There's no more emotional connection to the sale. So what I found is if you solve people's problems too early or you're too service oriented, it removes the emotional connection from the sale. And that's the only reason why people are going to make a decision to move forward if they're emotionally engaged.
It remains to be seen what the future of the industry looks like, obviously, and just how the landscape changes will certainly impact the way that advisors have to operate in order to be visible and be seen. But I think they're ultimately online marketing and just marketing in general. Marketing is going to have to become a focus of advisory firms. I'd have to pull up maybe we can find the citation for this, but I think it was an investment news article that showed financial services firms spend 2 to 3% of their gross revenue on marketing. Most industries spend 15 to 20%. And it's just, again, we have been able to survive historically on, well, I live closest to my clients, so therefore they will hire me. And that was true for a long time. That was your differentiation factor, was your office was closer to their office. I think we are still in an era where we can survive on that. I just don't think we can thrive on that. And it will become harder and harder to survive over time.
Yeah, it's going to be more difficult. I mean, just with Edward Jones, think about Edward Jones. Edward Jones is essentially bidding up the price of all of the clients that we could potentially get, whether they're a good fit or not. Think about Facebook. Let's say Edward Jones, Merrill Lynch, Morgan Stanley, all these companies move into buying Facebook ads. They can afford to spend more money than we can. So the only option that we have is to build that audience either in a different way or build it in a better way. And the only way that I found that works is to communicate like a human. That way you can reduce your acquisition costs because, as you said, that a lot of the things that people are pushing right now, like automate your content curation and hire somebody to write your content for you, none of that works. It's never worked. It never will work ever in the history of the world because people are craving authenticity. They want to see behind the curtain. They want to see what you actually do. And all the content that you create has to get to that point, has to get to the point where you're communicating authentically, whether it's your personal philosophy around planning or why you became an advisor, whether it's, you sharing a card that one of your clients sent you because you did an awesome job, just kind of results share. I know we can't do testimonials, but just thanking them. And then there's also really creative ways that you can use social media to build better relationships with your clients. There's a lot of articles, you've probably seen these, Alan, that say that the referral rates in our industry are at an all-time low. And my thought with that is it makes sense. One, because most advisors are streamlining their service delivery. So they're meeting like once every year or twice a year. So what happens in that paradigm? Well, the client doesn't remember who you are. So you're going to become less referable because you're not as relevant to them. And also they're getting bombarded with information through all channels. So they have less and less time and attention. So what if you were to run Facebook ads that only targeted your clients, expressing gratitude and thanking them for their business, and then having them see a video of you thanking them and just pushing out content through video to reinforce that message that you're around, that you're here, you're doing stuff. You're going to get interaction from your clients, and that's going to go out to their network. So more people are going to see it. And also they're going to feel closer to you. So they're going to remember to refer. So I think that our industry for too long has been designed around this idea of don't meet with your clients because you're not going to be able to scale, which I agree with, and then communicate with them like a robot and send out newsletters, curated spam, and all of the above to essentially, I guess, build a relationship, but it never works.
Yeah, I do think the referral marketing, I don't know that our clients are referring less. I haven't seen that piece. I have seen that advisors are not getting the referrals. And I do wonder if a lot of the breakdown is in the fact that, ultimately clients are now going to the internet to validate. And what they're finding is an advisor that they don't like the marketing feel. As it used to be like, oh, my mom or my buddy told me that, I need to call this advisor. So you just call them and you go meet with them. And that was our opportunity to sell. And now we have this digital storefront that many times is left completely vacant and looks boarded up, that folks are driving by virtually and finding like, oh, well, like this company doesn't even exist, or this advisor doesn't exist, or, they work with a totally different client base. And that's why I think it's so important to say who you work with and be willing to stand behind it.
Couldn't agree more. It's the challenge is that if you're relying on people to find you, it's going to become harder and harder and more expensive. So it gets back to that whole idea of the audience building. You have to have an effective mechanism to build an audience. If you don't, it's going to become increasingly difficult to get traffic at all.
So on your bio, on your consulting page, so brewerconsulting.co, you say that you built your firm from zero to $250,000 in annual revenue in 13 months. So what was your strategy for audience building and then conversion to get those clients signed up? And I'm assuming that includes parent company as well as the physician focus.
Yeah. Oh, I mean, maybe we can go for another hour with this, but I'll try and keep it short. So we started with the Medicare side of the business because we already had that sales funnel up, tested, structured. So the way that we structured the Medicare sales funnel was we had basically video ads that would go out to people that were turning 65, and they would be progressive. The first ad would basically be around helping that person, that 64-year-old, understand that they were in pain, right? You're trying to illuminate the pain that they face as they age into Medicare. It's about a 2-minute video, and then you offer up some collateral to help them solve the problem. The second video goes out to people that consume the first video and says, hey, you watched a good percentage of that first video. Here's a way to solve your problem. Not all the answers, the solutions, but here's one way you can think about solving this problem. And then the third video goes out and essentially says, well, you have two paths. You can solve it on your own, or we can help you solve it. If they wanted help solving the problem, they could either sit through a webinar, and at the end of the webinar, it would drive them to a call with an agent to help them with Medicare, or they could go to a workshop locally. So we were trying to test both. The workshops work a little better, again, because older people are just more relationally driven, and humans in general are just more relationally driven. So we tested both approaches, and we started to upsell wealth management to the Medicare clients to get some AUM on the books, because I wanted to start with older clients first to build out the AUM base and get sustainable, and then shift into seeing if I could crack the code for marketing for younger clients on a more retainer basis. So after we started to get some consistency around, which took some time, took a couple of months to get some consistency around this, we switched to audience building for SurePath Physician Services. And here we were focused on younger doctors, about anywhere from 25 to 40, that were graduating from school, that had massive student loans, and that didn't really know where to put their money, right? And we started by building that audience on LinkedIn. We created some automation, some rules, and some outreach methods to build that audience on LinkedIn. And then we started to reach out and get these people to have calls with us. So on the call, we have a specific sales process to get them to the point where they emotionally commit to wanting to solve the problem. Instead of us trying to solve the problem on the phone, we get an emotional commitment from them to want to move forward and solve this issue. And then from there, we've brought on probably about 2 or so doctors a month on a retainer basis to SurePath Physician Services, all while still marketing through SurePath Wealth Management. And we introduced a couple other local marketing strategies as well. Then after about 2 to 3 months of testing and iterating on our approach with SurePath Physician Services and our wealth management firm, I didn't have how am I going to say this? So I kind of stepped back and I'm like, am I really building a massive RIA? Is that what I want to do? Because I have an approach that will work. And I really enjoyed my time at Dimensional and I like consulting with advisors. Would this make more sense to open it up to guys that I think can help people, right? Because that's ultimately what we're all trying to do here. We're all fiduciaries that are trying to help people solve problems. The challenge that we face is we can't get our unique message in front of enough people. And the industry is just polluted by salespeople. So how do we get in front of people in creative ways to tell our story where we can connect with them and we can get them on board as clients? And I'm thinking I've already had a failed succession attempt once and trying to build this massive roll up. I'm not great with the human interaction, like the relational side of the business. I'm more on the strategy side. So I figured, let me spin up a 1-page website, offer this up to advisors and see if anyone would be interested. That was kind of my thought behind it. And there was a lot of people that were interested. So from there, we just kind of kept iterating and growing and kind of training them on the same strategies that we've used. And we've gotten great results. I mean, we've gotten advisors that have brought on multiple clients a month that have become part of our community, which has been great. And we're just continuing to test and evolve. So I feel like where we fit in the world is I'm committed to continuing to grow the RIA, but it's not going to be me meeting with people. It's going to be somebody else that's coming on next month. And I'm going to test every single marketing strategy that we do inside of the RIA. And then I'm going to make it available to people in our group when it's been tested and give them the blueprint and the strategies in order to execute it so that we can get fiduciary advice out to the masses so that they don't continue to take in the same message and think that we're all homogenous. It's difficult. There's no 100% right way to do it, but I feel like we're most of the way there. And the way that I got there was by failing a lot and spending a lot of money and just reading a ton. So I know that you've done the same thing as far as getting XY Planning Network to the degree where it's at. And dude, I can't believe you've done that so fast. But, it's pretty amazing what you guys have been able to accomplish.
We hired a really good marketing person. It's much of our success is just Jen. It's just kind of funny that you don't have to overinvest.
Yeah. Yeah. And I agree. I mean, the way that we structure it is I feel like most advisors, their only focus, if they're under 100 million, should be on marketing and sales. I mean, you have to have the investments tight. You have to have the operations set up. But the first thing that you need to understand is that you run a marketing and sales organization and you need to figure out how to build an audience. So the way that we did it in our practice is not the same as I would necessarily recommend somebody else to do it. It really just depends first on what you're building, how you're structured, what you want out of your business, and then that will dictate the platforms and the strategy that you take.
Totally agree. Well, Patrick, thank you so much for taking the time to be on the show. I'll close out with the final question, and that is, if there's one piece of advice, one thing that you've learned through this business building process that you wish you could go back and give, younger Patrick that was maybe looking at starting his own financial planning firm, what do you think that piece of advice would be?
Slow down, I'd say. And maybe the second piece of advice would be get people that can fill out your skill set sooner than later. I feel like that is the key to getting leverage and creating a business that will ultimately be fulfilling, at least for me. Not everybody wants to work with people. I get that. But having a team that is momentum driven, that understands the goal and they're operating under their kind of leverage purpose, building things. To me, that if I could do that sooner, I would have done it sooner.
Fantastic. Well, again, thank you so much for taking the time to be on the show. We appreciate you coming on and sharing your expertise and career path.
Thanks, Alan. I really appreciate it, man.
Be sure to join our VIP community at xyplanningnetwork.com/VIP to hang out with other XYPN radio listeners, ask questions for future mailbag episodes with myself and Kitsis, and to finally find a community of like-minded financial advisors. Thanks so much for joining me today. We'll see you next time.
You're not alone, and you're not crazy. It's scary starting, building, and growing your own financial planning firm. And that's why we put together a free private community just for you, the Cutting Edge Financial Planner. Go to xyplanningnetwork.com/VIP or text XYPN Radio to 33344 and join a network of thousands ready to change the lives of Gen X and Gen Y clients.